All right, the market's set to give back much of yesterday's gains. In fact, futures right now, they are down fairly sizably. We are seeing Dow futures off about 350 points. NASDAQ futures not down 2%, but not far off that. Maybe not going to give back all the gains yesterday, but certainly a lot. Joining us now to talk about the longer-term strategy is Megan Horniman, Chief Investment Officer at Verdence Capital Advisors. Megan, yesterday felt so good, didn't it? I mean, a Tuesday off a long weekend. We had these huge gains. Everything was up. Classic bear market rally bounce, it feels like. We're down 30% on the NASDAQ from the all-time highs. What are you advising your clients to do right now, and how much more pain do you see happening in these stock markets?
Yeah, and what you had mentioned this earlier in the show that bear markets, they're very ugly when you're trying to find the bottom. You get a lot of very big downturns, then you get a lot of big days like we saw yesterday as well. You have to be patient. What we're advising clients is to look at over the history. If you look at the long term, when you see a 20% decline in the S&P 500, if you can be patient and ride out that volatility, if you enter when we drop 20%. A year later, returns are in the double digits and up 70% of the time. 3, 5, 10 years later, you're up 90 or 100% of the time with strong returns. So you have to be patient. Look at your long-term objectives.
And I'm going to butcher the stat, Megan, you'll forgive me, but there was some stat, and you'll know the basic sort of direction I'm going in, which is the reason you stay invested is that if you took out like the best 50 single days in the market over the last 50 years, your returns long term would something like be cut in half. In other words, you never know when that 4 and 5% up day is coming. And if you try to time it, you get frustrated, you get scared, you panic, you sell. You're probably going to miss those days. And as tough as it is watching this thing ride its way down, those sneaky big days, kind of like yesterday, will ultimately help your longer term returns.
Absolutely. You've got it right there. I mean, the point is in bear markets is you've got to look at the long term, and you also have to have some dry powder on the sidelines to take advantage of opportunities. And there will be opportunities. Right now, we're just in a position where there's a lot of price discovery going on, a lot of uncertainty around the economic situation, the earnings situation. But there will be opportunity as we get to that peak pessimism in select areas of the market, sectors that have good fundamentals. The one thing we've learned about this bear market is that the end of free money, it's over. That free money regime that we had over the past decade is over. It's back to looking at fundamentals of companies, good cash flow, low debt, margins that can withstand this economic uncertainty as well.
And I think part of the hard part, Megan, and I said this last year, and I said it at a conference actually in March, which is one of the biggest risks to this market is that if you're under the age of, 45 or something, or 50 even, you've never managed money in an environment like this. We haven't seen a real aggressive rate rising environment since 1994, 1995, and we didn't even have the inflation then. So there's not a lot of historical models that probably the bulk of Wall Street fund managers have in their playbook, is there? This is kind of a new thing, a 30-year new phenomena.
Absolutely. You got to go back to the 70s and 80s and look at that time period to try and get an idea of what we may see going forward. And what we do know is that if you look at those parts of the market, those big mega tech growth companies that enjoy these decades long of this free money, that's going to be a very challenging environment to be invested in right now. It's not to say there are not going to be opportunity in these when we do see that kind of peak pessimism reached. But right now, I still think there's more downside for that.